Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, very good. Evan, today I wanted to focus really a look back over 2017, what has happened with interest rates, which we know the answer to already, nothing.
Zero. And not only that, therefore, you've got to look at it, there will be records now pretty much for the next future as well. But let's look back at 2017 and what interest rates did. Start of the year, there was some bullishness around what the RBA might be doing on interest rates, and we have a new governor. He's now been in there for almost 18 months. He's clearly more hawkish. So there was, if you look back in what was being said in January, February, even all the way through to possibly June, there was always this belief that the RBA was getting, the ability to possibly move back towards where they were in 2015 when we had those 50 basis points cuts, but never came to fruition. So it's a really interesting year because there are clear points that they are trying to highlight as reasons to move on rates, but the environment hasn't been there.
Yeah, and I think that's the key point, isn't it? That all through the year we've heard all the reasons why rates are going to move. They haven't moved. They're not expected to move anytime soon into 2018, which I think from an investor point of view is the real key, isn't it? What's going to happen in terms of my borrowings that I may have or might go into in the short term.
Yeah, and let's look at that. So look at this year about why the environment really turned against them. And I think that needs to be sort of pointed out. I mean, a lot of people were clearly getting very bullish also on the idea that rates could move soon in end of July, start of through to September, and that's where things moved against them. So you have the issue, and we've spoken about it many times this year, the differential, the gap between what's going on in employment, which is really positive, but nothing in wages. You then look at inflation, and inflation is the end-up mandate of the RBA, just isn't there. And not only that, they're now forecasting it won't hit their target band for the next 2 years. So the environment just isn't conducive. We had a good positive year in net exports. We had a really good year in government spending, but that shouldn't be a reason to be raising rates because private investment has just not got there yet. Now, the interesting thing is that the very end of the year, so the CapEx numbers we've just had, have given them hope that maybe 2018 could be there. In their last meeting of the year, they sort of alluded to that idea that they are fairly positive on CapEx. Private spending is possibly picking up. Government spending will hold. Consumption's the interesting one. They're a little bit tentative on pointing out consumption, but the RBA now has this environment where it is just so neutral. There are pros and cons on either side. The ability to therefore look at rates moving is hard. So looking at the investment point of view, and this is where I think you need to look at it, looking at it from an investment point of view, you probably need to look at the idea that the RBA, not only is it out of the market, but it shouldn't really have a material impact on rate movements or borrowing for the foreseeable future. What will be is global factors. Look at what's going on in the States. The big four banks here are going to have to start rolling over some of their debt materials in the next 2 years, and that will be more of an impact. And 2017, part of why rates didn't move is that on the other side, owner-occupier. And then we can go granular. Look at what's happened in the housing market. Owner-occupier, you've had interest-only loans, investment loans, movements from into owner-occupier, away from just straight-out investment. All of that has actually hit the market, and that's a good thing in terms of it takes that pressure out of the housing market, because that's the one part that they're really concerned about, and it's actually happening naturally, almost organically through the market.
I received a letter a couple of weeks ago from one of my lenders saying we're going to move our rates up. You're on an interest-only loan. If you switch to principal and interest now or in the next couple of months, we'll waive the fees. It's going to cost you a little bit more, but you'll probably sort of end up coming out in front. So I have done that. And what I've seen over the year is that the banks have been moving up their interest-only rates, but in some cases, and I heard that in the last couple of weeks, banks have been advising that they're dropping their fixed-rate loans under 4% again, which is quite interesting. And I suppose from an investor perspective, would you lock in or would you stay variable?
Yeah, good question. And what I would actually point to that, yes, in terms of your absolute payments per month, you're paying more. But if you look at the core component here, which is the interest part of your component of your P&I versus an IO, you're on average now 45 basis points better. So you're close enough to half of 1% better off having a principal and interest only loan. A principal and interest loan, for the reason being that they are trying to basically de-risk their book. So the catch to it is exactly as you said. Now, locking in, it's an interesting conundrum because you do get a cheaper rate again, and there's there are signs of doing that being a positive. The catch versus a variable mortgage rate versus a fixed mortgage rate is again things like offsets. So inside the products themselves, they're differential. It is clear that we will not get rates going lower. I think that needs to be the base case. So yes, you could possibly think about locking in rates for that reason, that the probability of rates going lower is significantly less than the probability of them going higher, and the probability of both of those scenarios is next to nothing in at least the next 6 months. So yeah, if you're looking at locking in for the possibility of 2 or 3 year term, maybe, because at least over that period of time, you would expect probably 1, maybe 2 movements to the upside. But again, I think it's more around looking back granular. The P&I push is going to get stronger. There's clear movements from the banks to push towards that space, and it is better for the home loaner, even though you are putting a little bit further out. You're paying off your principal, you're paying off the loan that you've borrowed, and you're paying lower interest. In terms of just a simple looking at that from an investment point of view, or looking at it from an actual just a household savings point of view, it is better. You're paying, and you'll pay off your home faster. The asset value that you hold is bigger, etc., etc. So yeah, that drive is going to happen because there's twofold. It's de-risking the banks. The banks clearly are concerned that the bad and doubtful debt cycle could change, and interest-only loans are a big headache there. And then you've also got a scenario where, yeah, actually, if you look at it from the personal point, yes, there's a little bit harder, maybe $400-500 extra because you're paying your principal, but in the main, the interest, which is almost dead idea, is less, and that's a positive.
Yeah, and I think as a an investor, whether you're borrowing money for property or for other assets, it's really something to consider in terms of what's going to happen to rates over the slightly longer term from what we think we know, in that the Reserve Bank is not likely to do anything with official rates.
And that's why I think 2017 has been a really interesting year from that perspective. So it isn't, and people have woken up to the idea that the RBA isn't the only core mover of interest rates. And that is what this needs to be about, is that everybody has sort of come to this belief that if the cash rate moves, my interest rate will move. It's not that simple. And as we've spoken about many times this year, and it's really come front and center, is that bank funding isn't just term deposits from mums and dads or the investor. They put a margin and then they lend it out to you. It's mums and dads plus other treasury money, wholesale money from the States, from Europe, wherever it happens to be, wholesale money from here, and they're variable movements. They're bonds, they are structured bonds, they're private bonds, etc. Those rates move depending on risk and all that kind of stuff, and therefore you do have a variable part of the funding side that the bank has to take into consideration. So that is what people have woken up to this year, and that I think is what's been actually good about this 2017, is that the RBA, although it's out, has told you and shown you that banks have other things to think about, and investor loans and interest-only loans have been caught up with that.
Have we seen much change in the wording from the Reserve Bank over this year? I know that every month we pore over their statements to see what words have changed, if there's any inflection point, coming, or any concerns from the Reserve Bank.
There has, specifically 3 points. The Aussie dollar has dropped in and out, and that's been really interesting itself. So yesterday was a really, really interesting point that they actually pointed out that over the last 2 years, the Aussie dollar has been stuck in a really tight trading band between 72 and 82 cents. And it's done that consistently now for almost 2 years. And so it's dropped in and out because they have always talked about the jawboning effect of trying to get the Aussie dollar lower, trying to help our exports in terms of looking and appearing cheaper to international traders. what they're now clearly trying to say is that they're not that concerned anymore about the Aussie, because clearly it's found this equilibrium point, and no matter how hard they'd love to try, they can't push it further lower. What they also then pointed out, and what's really started to come into fruition towards the back end of the year, is again what we've been saying for a little while: how much emphasis now is on the employment market and the impact on inflation. So wages has all of a sudden out of nowhere become this big flashpoint in terms of wages aren't growing. It's just ever so slightly above, inflation. Consumption's a real concern. That has changed. If you look at what we're saying in February through to June, from basically August through to now, that's the biggest change, is that inflation isn't materializing, which hadn't really been anything new. But the reason it isn't materializing is because we're really concerned that people's wages aren't growing. The other part that I would highlight is they put more and more emphasis on the US, which is not something new, but in 2017, they were clearly pointing to China and the growth story and how good our growth was going, terms of trade, blah, blah, blah. But it's the first time this year that they really put emphasis on the Fed and whether or not the Fed was going to move rates. And again, that's probably showing you that they are dead neutral. They probably can't control things as much as people would wish they could, like the currency, like interest rates, because we've got global factors. And that really moved further and closer that we got to the September meeting and now the December meeting, is that rate rises are going to happen in the US. That will mean the Aussie will go lower. It will therefore be good for our exports. But it's almost like it's hope, and that was really what happened in the statement.
2018 is going to be a really interesting year. I can't wait to get there. And next week, we're going to talk all about what's happened in the wider economy, GDP, balance of payments. We should have a look at that side of things too. So see you again next week, Evan.
Thanks, Tony.
Thanks for joining the Economic View.